This episode is brought to you by McIlvaney Financial Group. Their advisors bring a depth of knowledge and experience that allow them to serve their clientele with care, ensuring their financial needs are met now and in the future. Personally, I'm not saying cash is worthless, but you can see what's happening. It's worth less every year. Gold is the opposite. Click on the promo link in the show notes or go to www.mcilvaney.com/coffeeandamike. Don, thanks for doing this. And let me mention Eric Jung for making this introduction and mentioning you on the last conversation I recorded with him. So thank you, Eric, and thanks for taking time. I appreciate this.
Yeah, Mike, thanks for having me on.
I want to start off with it. We're going to talk about precious metals. We'll talk about, where you think the S&P is going. But, we both, being in Arizona, I am fascinated by the amount of construction that's going on here right now. And I can't believe. So let me list off a couple things here. Headquarters that are being built. Axon just got approved for 76 acres, new headquarters that's going to include apartments, restaurant, hotel, etc. Republic is getting ready to open their headquarters in January. Sprouts is going to be building a headquarters right next to Republic. The Arizona Cardinals are building a 28,000 square foot practice facility, which I don't know when they start breaking ground for that, but I think that they've designated the area where they're going to be building that. And then on top of all of that, I see more apartments, more housing. It makes no sense to me, Don. What are your thoughts?
I live in the same area, and I drove and I saw them breaking ground on apartments, quite a few of them. And basically, I kind of rolled my eyes and said, this won't last, if you will. So Arizona has low taxes, 2.5%. I mean, it's one of the lower tax states there are. And there's not a lot of low tax states, period, in the country. And California is the highest tax state. It's right next door. And Nevada is a zero tax, but people don't really want to live in Nevada. People want to live in Las Vegas. People they just don't want to live there. And so they're not building these headquarters in Las Vegas, right? They just don't want to live there. And so you don't have a lot of choices. Where are you going to build your headquarters? You don't want to go in California. Texas is one choice, of course, but Arizona, Phoenix, it's been popular haven. 4 million, greater Phoenix area is 4 million. People tend to like it here. Again, the low taxes, the climate. You got to put up with the summer, the 4 months of heat. But after that, you got 8 months of nice weather. Florida, for instance, you got to put up with hurricanes. People don't really like the hurricanes, right? The summers are brutal, the high humidity. So for me, I just think it's the only reason why it's growing here is because it's the location, believe it or not. It's not about the economy being strong. The economy isn't strong. As a matter of fact, the economy is getting weaker. I mean, I posted last night a chart of the jobs growth for the last 5 months, and it's flat as a pancake. So job growth is flat. I don't see any green shoots out there picking up. I mean, you can point to the construction in Phoenix, Arizona as green shoots, but I'm not buying it. The consumer's broke, and the consumer's not getting healthy. The wage growth right now is about 2.5%. You're not getting ahead. Inflation's above 2.5. You're falling behind. And not only are you falling behind, but you're way behind the 8 ball already because prices jumped since 2020 and you haven't caught up. So by and large, we have an economy that's been basically held up through manipulation since 2008. In 2008, we just jumped on the MMT bandwagon. We just copied it in Japan and just said, don't worry, we'll just we'll lower rates and print money. That was MMT. That's what Japan did in 1991 forward. They basically took rates to zero and they printed money. And now they have a debt to GDP like 230%. It's insanity. And now we're catching up to them. We're at 120%. And so we're just copying their same playbook, but it's allowed liquidity, enough liquidity in the system, and enough those low rates where you get free money to make things appear to be okay. I mean, the consumer confidence level in 2017, 18, 19 was like over 90. I think in 2019 it was like 95, that's normal consumer confidence in a good economy when everybody's kind of comfortable. Today it's at 50, 50, 50. And we're not even close. 70 would be bad. 75 would be, we have problems. We're at 50. This is not a strong economy. This is an economy it's sick, if you will. We have pneumonia, but the S&P 500 is at an all-time high because, the top companies, they have this monopolistic, the Metas and the Facebooks and the Googles of the world, Microsofts, they have this very strong competitive advantage versus their competitors, and they make a boatload of money, and they overweight the profitability, they overweight the earnings to make it look okay, and everybody's putting their money into these stocks till they're overweight, and it makes it look stronger. But if you look underneath the covers, it's not so strong. Most companies, if you will, are struggling. They're struggling to give their employees raises. They're struggling to grow. This is not a strong economy at all. And so I'm waiting for the shoe to drop, and I'm confident it is going to drop. Very confident. And basically, we've been living on easy street since 1945 in this country. Our standard of living has done nothing but go up. But that standard of living has been pushed higher and held higher by foreign money since 1980. We've been living off of debt since 1980, and living on the backs of foreign money. And the foreigners, this is where, if you really do your research and you really connect the dots, you start to see that the whole system that has been in place, I mean, you really have to go back to 1945 and go forward and look at exactly what's happened to the U.S. economy. And you can really see that something really changed. So from 1945 to 1972, we had a mercantilistic economy, low inflation, strong growth, which was beautiful. We had the best of all worlds. Then it ended in the 70s. We had basically mercantilism ended, and we had two energy crises. We had inflation. That was the shift. That was the trigger in the 70s when everything broke. And then in the 80s, we was like, okay, what's the path forward here? And Reagan said, globalism. Let's do globalism. That's probably the, and everybody, politicians, they always take the easy road, right? The easy road, and it's not necessarily the good road. The hard road would be to compete, try to maintain a mercantilistic economy and compete. And like, no, we're not going to do that. We're going to take the easy road. We're just going to shift our manufacturing overseas. And that was the beginning of the hollowing out of the middle class. And then it also was the beginning of living on debt. So it was a two-pronged approach. Both of them were going to lead to bad things, bad outcomes. This is where we're at today. Number one, the middle class got hollowed out. And number two, we started living on debt. And now we have $1 trillion in interest payments. Last year it was actually 1.2 trillion. Everybody thinks it's fine, but it's not fine. And the bubble has gotten bigger and bigger. It's gotten so bad now we call it the everything bubble. The everything bubble, right? That's how bad it's gotten. And we're over levered, and the economy's weak. And now how do we keep this thing going? And the kryptonite of MMT is inflation. Once inflation shows up, you're screwed. And that's where we're at today. So what I mean by being screwed is the Fed now is trapped. Powell said it. I don't know if he said it in Jackson Hole or said it in September, but he said we cannot fight both. We cannot fight inflation and support the economy, full employment simultaneously. We have to choose. He said it. He said the bad part out loud. We have to choose. And so they said, well, we think that the biggest risk is full employment. We're gonna work on that, and we're gonna hope and pray that inflation doesn't increase. And so that's the problem with M&T. Once that inflation shows up, you no longer have the tools to fight things. And so things are slowing. We're holding. The thing is that we're just hanging on is what we're doing here. Trying to lower interest rates back, get enough liquidity in this thing. It's basically what Janet Yellen said when she was the Fed chair. She said, we're not going to have another recession in my lifetime. I'm like, what? So what she was saying is, we got this. This MMT stuff's great. We can lower rates, print money, we can manipulate. We got this. We got it. Don't worry. In my lifetime, maybe she didn't say recession. Maybe she said crisis. But she said, don't worry, we're good. We got this now. MMT works. It's the cat's meow.
Don, for people that don't know what MMT, not to interrupt you, but explain what MMT is, the definition.
Yeah, so it didn't exist. It was what what Japan did. It's called modern monetary theory. A couple of people wrote books on it, and it was kind of hilarious what they wrote in the books. They basically said that debt no longer matters. That's kind of the crux of modern monetary theory, is that you can manipulate through liquidity. If you create enough liquidity, you will prevent a crisis. So you go back to the 30s. The reason why we had the Depression is there wasn't enough liquidity. If you would have just printed enough money, everything would have just kept going up, up, up. Now, but the problem and I forget her first name. Her last name was Kelton. She wrote a book on this, and she actually was interviewed, and she was talking about, we can print as much money as we want. It was kind of hilarious. You don't hear her talking too much. Do you remember her first name? Kelton? No, Kelton. I forget. Well, anyway, she was interviewed a few times, and she's basically said, she wrote this book on monetary theory, that as a nation, we can print the money we need. That's in a nutshell, that's kind of what monetary. So if we need money, if we need liquidity, we can do it. And because that's what the Japanese did. The Japanese are like, okay, in 1989, their debt bubble popped, and they're like, what do we do here? And they just started printing like crazy. Now, they monetize it internally, and it didn't create inflation. But we don't monetize it internally, and we're integrated with the whole global economy because we export our debt, and we got inflation in 22, 23, and so now it doesn't work for us. Now that's why you don't hear anybody talking about it anymore. The cat's out of the bag. Wait a minute, that theory doesn't hold water. Everybody knows that inflation is the kryptonite of monetary MMT.
So I want to go back a second here to 2008, because I moved here in 2006, and people that have listened to me for a while, I'm sorry I'm boring you with the same old story, but I think it's important for this conversation. I moved here, I was in retail banking, I was doing a lot of home equity lines, and I was so intimidated when I got here. It was December of 2006, actually 19 years ago this week, ironically, that everybody I met had multiple properties. And I was like, oh my God, I'm never going to be able to make it in this town. 2 houses, 3 houses, condo, building everywhere, retail, it was nonstop. And then in 2008, it just felt like it halted and crashed. And one of the things I remind, people, where I'm from in Northeast Ohio, they didn't feel that pain that they felt here and in Vegas and in California and so on. And because their property values weren't skyrocketing. But you saw projects here that just stopped. And I remember one in particular, it was called City Center. And it was going to be the spot. It was going to have Bloomingdale, Saks, Nordstrom. All these smaller mom and pops had gone into it with the anticipation that these big box stores were going to follow up. Well, they all backed out. So it turned into a graveyard. There were freeways where they had built the exits not the ramps, but they had built the bridge and the part of the road, and it just halted. So all this stuff that's happening around here right now in other parts of the country, it could just stop at any given moment.
It's going to not. It's going to be really, really bad. It's going to be worse. You say it halted in 2008, but after in 2009, we were back on our feet again. It was really a 9-month recession. This one is going to be extended, but it's going to be worse than that because we basically have been, the bond market is kind of the fulcrum of the whole economy. The bond market, the US government bond market, that creates the foundation of the whole thing. And then that leads to your corporate bonds, and it leads to banking loans as well. It's all, that whole credit market is the foundation of everything. Without credit, you don't have businesses. Without credit, you don't have the stock market. The bond market is by far the most important market we have. And that's what's cracking, and that's what's going to break. And when that breaks, it's going to be really, really ugly. As a matter of fact, I'm looking at your flag behind you. The United States is not going to survive this. So that flag behind you is going to be historic, because we're not going to have 50 states in, say, 10 years. And the breakdown, so we've already seen the beginning of the breakup, right? Which is our political system, the bifurcation of our political system. That's kind of the clue that America is going to break up. And then the political changes, we've had this bifurcation in values. And that's really, once the values bifurcate, there's no going back. There's no meeting of the minds. And so the last thing that's keeping the country together right now is the economy. And once the economy goes, the country goes. That's a sad thing. And so the bond market is, as long as the bond market, they can print what they need and keep, kind of keep it going, if you will, and not allow kind of a breakdown, then we're fine. We can keep kicking the can for another 10, 20 years. I mean, that's a possibility, but I only give that maybe a 2% chance. I just don't see that happening here because of what's happening internationally. It's the international impact. If this thing was all self-contained in the US and we weren't the global currency of the world, and we weren't exporting our debt, and these central banks weren't holding our US treasuries, then we wouldn't have this problem. But the problem that we face is that when our economy weakens, at that point, everything just starts spinning out of control. And the big fulcrum again is that US bond market. So if the US government cannot borrow what it needs, so right now we need $2 trillion, but what people don't realize is that we're borrowing all of this money on the short term, 3 month, 6 month, and 1 year T-bills. And so we have to keep rolling these over every single year. So this year we had to borrow. I mean, the amount of money that we're borrowing on this bond market is unbelievable. So we have $2 trillion we have to borrow for the deficit. Then we have to borrow another approximately $7 or $8 trillion to roll over the debt. So we have to borrow $8, $9, $10 trillion. That is a massive amount of money. Now we were able to do that right now. We've been able to do that because our economy is still strong. But if we go into a recession and we weaken, no, we're not going to be able to borrow that kind of money. And that's when it all breaks. That's when it becomes fragile. And that's what's coming. And my belief, and I've, for a long time, I've held this belief that once you can't borrow what you need, it's kind of game over. A perfect example, a good analogy is a corporation. So let's say you're a corporation and you're not making money, but the bank isn't calling your loan and the bank is keeping your credit line open. As long as that credit line's open, you stay in business. And those are called zombie corporations. They basically, the only way that they can stay alive is more and more credit. The banks literally, keeping them alive. And otherwise they'd be, they're zombies. And so that is the same situation. Once the credit gets pulled from that corporation, they're bankrupt immediately. Once they cannot borrow more money, the message basically, okay, you have to make your payments. Now you have to make your payments. Well, we don't have the money to make our payments. We can't service our debt. There's no difference in the U.S. If we can't service our debt, it's a game over situation, and that's when the house of cards and the dominoes start to fall, because the rest of the world is holding so much of our debt, and they don't have to hold it; they can dump it. And if they dump it, who's going to buy it? And you can see it starts spiraling out of control. You get a doom loop really fast, because once perfect example is China and Japan. So China in 2013 had $1.5 trillion of our debt. Since then, they've been net sellers. Now they're down to 750. So they've sold half. 1.5 trillion to down to 750 billion. They've sold half over 10 plus years. They're net sellers. They do buy a little bit each year, but they sell more, or they let the old ones roll off. So it's slowly shrinking. Well, Japan hasn't started selling yet. They sold a little bit last year, but they're still about $1 trillion. At a certain point, if Japan they've been okay with holding our bonds. They haven't been net sellers. But if we go into a situation where it starts to look dicey for them to get paid back, or if they think that we're just going to inflate the hell out of these, inflate them out, and they're holding the bag, and then China gets a little ahead of them, and then China starts selling more aggressively. If China gets sub 500 billion, do you really think that Japan's just going to sit on 1 trillion? I don't. I think Japan's going to go, we got to get out of these. And then you don't have any, then you have a lot of net sellers. If Japan and China speed up their selling, the rest of the world's going to speed up their selling too. You don't want to be left holding the bag. So this is the problem that happens when you get into a debt problem, which the U.S. has. The U.S. has gotten into this debt problem. We've thought that, we had this, everybody thought, well, we have this, this dynamic economy that's very creative. We have the biggest companies in the world. We have the highest standard, well, maybe not the highest standard of living in the world anymore. We don't. But we have this high standard of living, tons of, one of the biggest markets. Everything's fine. Everything's fine. But if you look closer, you can see that things are fragmenting, things are breaking down. And that's why it's like, we're approaching a Katie bar the door moment. We're close. We're really close. It can happen at any moment. And I'm going to bring up a chart, and I'm going to show you the one chart that I think is going to bring the whole thing down.
Do that now? Yeah,
let's do it. Let's go ahead and then I'll kind of pivot into gold, because when I bring up my charts, I want to bring those up as well. I wish I had an S&P chart. I don't have the S&P. Okay, so this is the chart that I think is going to bring the whole thing down. And this is NVIDIA's chart. And so if we look at number one, this is a daily chart. So in June, we basically had this big rip, NVIDIA from $100 all the way. It just ripped all the way up to 185, which is exactly where we're at today. We're basically 185. So we ripped all the way up there. And so that was in August. So NVIDIA hasn't done anything since August 1st. And then once we had this breakout, we got to 185. Once we got to 185, we've basically been in this channel ever since August. We've been in this channel. And these channels can be, they can either be basing events or they can be breakdown events. And so we've been in this channel. We broke out, this number 5, we actually broke out right here, this 150 level, which is, I think, where we're going back. You can see these three green bars, green candles is breakout. This is when we broke out at 150, went to 180 fairly quickly. This is when NVIDIA had basically a dominant competitive position in their AI chips. And then they went into this channel, and then right here, we had this breakout. We based right here at 185. We couldn't break out. We broke down, but this was the bottom of this channel. And then we started riding the channel up. And I think this is really the last wave upward of NVIDIA here. And then we had this breakout right here just recently in October. We were at 175, and we had these 4 daily candles, and we ripped all the way up to 212. So we went from 175. These are daily candles, by the way. 1, 2, 3, 4, 5 days. In 5 days, we went from 175 to 212. I think that was the meltdown, the blow-off rally in NVIDIA. Then you had 6 red candles in a row, which was kind of the sign. Actually, it's 7. 7 red candles in a row. Right here, this is the topping pattern. When you had 7 red candles in a row, the topping, and basically you couldn't get a new high here. And then it broke down, and this red candle, this red candle right here, this big red candle right here, I think that was kind of where we were 195. Well, maybe that wasn't the one that killed it, but we went all the way back down to 185. So we're at 212, and if you look left all the way to August 1st, we were at 185, and we broke down, and now we're back in this. We went back in the channel, so we're retesting the top of the channel at 185, and then we had this nasty red candle right here, where it basically tried to break out. And this candle right here is probably the end of NVIDIA, where this was when they did their earnings, and they actually opened plus. They opened all the way. It went all the way up to 195, and then it went all the way down to 175, and then closed way below the 185 level. So this is where we're at. So the key here for NVIDIA, and I think again, I think this is the company that's going to end it all, because the AI trade has really been holding everything up. So the key here is, do we go back and get a new high, or do we go back, this number 5 here, do we go back and retest this gap and go back and fill this gap? And I think that's where we're going. And once we go below 150, I think NVIDIA is dead. Now, the reason why I think NVIDIA is dead is because they grew too fast. They were at $300 billion market cap in 2021. 300 billion. Today they're at 4.2 trillion. 10x company. They went 10x in 3 years. They went from a $300 billion market cap to the biggest market cap in the world. But the problem is, now they have competition. That's the reason why they're in trouble here. There's 3 companies in China that are making chips already today that are competing against them. And there's 2 companies in the US, AMD, forget the other company.
Isn't Google now in the space?
Oh yeah, Google. Thank you.
Don, are you done sharing your screen?
No, I'm not.
Oh, okay.
I got more. The Tensor chip. So they have 5 competitors, 5. And back here when they were going nuts, they had 0 competitors. So, they had 0 competitors of any strength at all. But now they have 5. And Google, wasn't Google, Meta, they basically came out and said, we think we're going to use the Tensor chips. We're not going to buy any more of those NVIDIAs. So NVIDIA is not going to be able to hold this level. So I think it's just, I just think if NVIDIA is going to lose, if NVIDIA is going to crash, which I think it's going to, I think it's going to pull down the entire market. Because again, the AI market is what's been holding everything up. Now I want to go and show you.
Can I ask you something about NVIDIA while you're pulling that up real
Sure.
quick?
Yeah.
Do you see a scenario though where the Fed would step in and not allow Nvidia and some of these other OpenAI, et cetera, to fail?
They won't have a choice. This is a market competitive situation. They cannot create demand for Nvidia. Nvidia, they need to continue to grow, or else that stock isn't going to be able to be a $4 trillion company. See, the one thing that makes Apple and Google and those companies $4 trillion companies or $3 trillion companies is because they have built-in customers. They grow every month. Whereas Nvidia is like Ford or GM, they build, chips. You can't create demand for chips. So no, there's nothing the government can do for there. Now, the one thing the government can do is it could support Chat GPT, OpenAI, because they have ongoing customers. They might step in to save them, but I don't think they will, because there's plenty of AI companies in the US. Gemini, Grok. There's plenty of them. They don't need to save one of them. If OpenAI can't compete, they'll let it die, I believe. Okay.
One last thing I want to ask you about the Nvidia. So if that falls, you've
Yep.
got a lot of pensions, 401ks that are tied
Yep.
into this company and people
Yep.
probably not even willingly know. They don't even know that their retirements are tied into it. And this is one of the things
Right.
I have a conversation with a friend of mine, and we go back and forth about the Dow and how the Dow keeps hitting record highs. The stock market keeps growing, 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 growing. And I come back to what you just said with Nvidia. If Nvidia falls, I mean, they're going to get crushed. Regular people.
Exactly. I think that the S&P is going to fall 40%, 40. And here's the ugly thing. After it falls 40%, it's not going to recover. Now, that's what I'm going to show you right here. So if you go back and look at history, so this is 2001 to almost today. It's about a month old chart. But the S&P, we had the dot-com bubble pop in 2000, January 2000. And then we had 9/11 in September of 2001. After those two events occurred, the S&P didn't grow for 7 years. This line right here is the 0% growth line, zero. So it had no growth from '01 to '07. There was no growth in the S&P. It was flatlined. And it was down in '02, '03. You can see it basically lost money for an '02 and '03. The S&P, you actually lost money if you were in the S&P. But if you held, you made nothing. You made no money until 2014, 2013. We started basically the breakout, which is exactly when gold failed. Okay, so this chart, I think, is emblematic of where we're going with gold and silver and the miners. The HUI, by the way, is the gold miner index. And so S&P went flat, which I think is going to happen here very soon. And when it went flat, gold and the miners went up. And you can see the HUI went from under 100 all the way up to 600. So it was a 5x, more than 5x in 5 years, which is now it was already, the HUI is already up over 200%. So it's already starting to do this, but the S&P is also up.
HUI,
So
Don, let me interrupt you for a second. HUI, for people that don't know what that means.
yeah, it's just a symbol. The HUI doesn't really mean anything. It's not an acronym. It's basically it's just a symbol. It's an index. It's called the Gold Bugs Index, and I've been using it because it's been around. You can look it up and you can see what miners are in there. You can't own the HUI, but the HUI it correlates to GDX. It's basically your large cap gold miners. But GDX didn't exist in 2001. So I can't use GDX, so I use HUI. It's basically the same thing as the GDX today, but since the GDX doesn't go back to 2001, I can't use it. So I use the HUI, and that's what I've been using since I started doing this in '04. And I've been using the HUI. So basically the HUI, you can see it just ripped, absolutely went straight up, and the stock market was flat. This is what I'm expecting to see happen. Again, now the S&P is still going up. It's at 6,800, but look what the HUI did. The HUI has been going absolutely straight up. And I'm going to show you why. But again, what I'm trying to show you there is we're still early. Okay, so this is gold. Now, what I want to show you on gold is that we were flat, pretty flat, um, until we broke out here in March. In March of 2024 is when we got above 2,000. And this was kind of we were basing here below 2,000 in 23. So in all of 23, we pretty much based right below 2,000. And then in 24, we broke out above 2,000. You can see these breakouts, you see these big candles. And these are weekly candles. So this is a big breakout. So we broke out above 2,000, and then we based about 2,200, 2,400. Well, 2,400 we based, and then we broke out again. We did a little basing at 24. Then we went up here and we broke out at 3,000. And this big green candle here is when we broke out at 3,000. And then we based again. And this is this year. This has just happened. This summer, we based at 3,300. And then we broke out at 3,300. You can see this big basing. And once we broke out here at 3,400, this correlates. Well, not really correlates. This is very recent. That's what the point I wanted to make is this was in August of this year is when silver, and I'm going to show you this, August, September, this is the breakout that's created this bull market. This is what's changed the whole flavor of the gold and silver market. This is why people are coming into the market. That's what I wanted to show everyone is that these candles right here, these weekly candles in gold, this is when silver got above 40 and everything kind of took off. So you had the breakout at 2,000 in February 24, but nobody really believed it. And then you got above 3,000 and nobody believed it. But now, once we got above this 3,300 level, this is when everybody said, okay, I believe you. So this is basically the confirmation breakout in gold. But the one thing I want to show you guys is that this is not a chart that's breaking down. This is a chart. This is a massive breakout chart that just keeps getting stronger and stronger. It just bases and goes higher, bases and goes higher. And that's what it's going to do. We're still early innings. I showed you that HUI chart, and I showed you where the S&P hasn't even stopped growing yet. And once it stops growing, gold's going to go even higher. Okay, so this is the silver chart. And so silver, it didn't even break out above 25 until 24. So remember that gold breakout in March. The gold breakout in March, and then in April, silver finally got above 20. You have this big green candle, it got above 25. Today's trading at 57. But these we can see some of these important green candles. So it didn't. This is kind of a recent phenomenon for silver. So silver broke out here, March, April 24. And then it went up to 30, and it got above 30 with this big green candle, but it couldn't break through. You see all these candles that are in the 30 range. So we're basically stuck at $30 until this year. We tried to break out at 34, but we couldn't. You can see 1, 2, 3, 4, 5 tries. And this try here totally failed. We crashed from 34 all the way to 28. So everybody thought we were breaking out, but that was a false breakdown. And it turned around a week later. And then we had this breakout candle here in May of 25 this year. So we've had two important breakouts in silver this year. The first one is this May-June candle where we got back to 34. So basically we had we broke out of this little basing channel and broke out. And it didn't take long. We did a little bit of basing at 38, and then here's the breakout. In August of this year, silver got above 38 and never looked back. And now silver's basing at $50. And now if you just looked at that gold chart and you saw how powerful the gold chart was, where we basically go up and base, go up and base, go up and base, that is what silver is starting. Silver is going to base here at 50, and then it won't go back to these levels. It's going to base somewhere in here. It's possible we could go to 42, 43. It's possible we come down in this area, but we might not. But then it'll immediately go back in this basing, and then we're going to go higher and higher and higher. I think 100 is easy. 150 is kind of my expectation. 200 is in play. I have one last chart to show, and that's this HUI chart. And so the HUI is the miners, and a lot of people follow the miners, so they're interested in the miners. So this is an important chart to show. So this is the bottom. The last bottom was in March in 24 when gold broke out. So gold broke out, that massive breakout, right when the miners were at the bottom at 200. Today they're at 660, 3x. So remember I showed you that HUI where the HUI went actually nuts in 2001? Well, the HUI has already started to go nuts, but it's going to continue to go nuts. So here we are at the very bottom. And then this is the bottom of the channel. This channel goes back to 2013. That channel goes, and the top of the channel from 2013 is all the way up here at 365, this breakout right here. So we come back, this candle right here in April of 25. April of this year was the breakout in the miners. This candle right here was the breakout. And then we basically came and based at 400, and then we really broke out. We just took off. But if you were paying attention, you would have basically had a really good feeling that's where we're going. The real breakout, I think, was this green candle, and then it was just a matter of time. It was just inching, and then boom. And then these candles right here, this minor breakout, this coincides with silver. And now we're basically basing 550, 600 here, and we're going to go a lot higher. So that's the end of I'm going to stop the share. So give people a little bit of an idea, a little overview of kind of what the metals have done, what the miners have done, and where we're going. And that kind of coincides with the S&P 500. I've said the S&P 500 is the most important chart for gold and silver by far, and that they're correlated. They've been correlated since February, March 24. They've been correlated. And every time gold has come back, anytime gold is corrected, as long as the S&P has went higher, gold has turned around and went higher. And so they're correlated. They'll remain correlated on the upside. And I believe they will remain correlated on the downside until gold basically says, whoa, until the market goes, wait a minute here. And they decouple. That decoupling is coming, I believe. And the decoupling will be the S&P will just keep going down and gold will turn around and go up.
So in regards to the S&P, in your estimation, will it be a fast drawdown or will it happen gradually?
The initial move down will be quick. Now, when I mean initial, I mean we're at 6,800. I think we'll go down to 6,200 in a week. So you'll go down 500 points or more in a single week, and then I think it'll be a little more gradual down to 5,500, and then a little more gradual down to 5,000, and then more gradual down to 4,000. In other words, I don't think we'll see a crash at all. I don't think we'll see we could see a 10% in 1 week, but I don't think we'll see 20% in a month. I think it'll be more of a 10% and then 5, 5, 5, 5, 5. It'll just be a slow burn in tandem with a few dead cat bounces. You're always going to get some dead cat bounces. So if you go from 68 to 62, it'll bounce to 65. And then it'll be back under 62, and you'll go down to 58, and it'll bounce back to 62. So you'll get a lot of dead cat bounces, but they won't hold. And after about 3 dead cat bounces fail, and then it's game over. Because at that point, people will give up. As a matter of fact, it's all about time. Investors have very little patience. They will wait. Some investors will wait 1 month, some 2, some 3, but very few investors will wait more than 3 months. So if this thing doesn't recover in 3 months, then it's pretty much a fait accompli. You're going down to 4,000. That's the way I look at it.
Do you see when this starts to occur that on the retail side there'll be such panic because people don't know what they don't know, right? And in the age of social media, you're able to share information so quickly, and that's the difference to where we're at now versus 2008 because you didn't have that ability back then, right? And I think that situation, I mean, maybe the Fed or powers that be would have intervened and we would have had outages that you wouldn't be able to use Twitter, and maybe that's a scenario that could happen this time around. But retailers could freak out.
They will. They absolutely will. The problem is, I think it's 60% of all the S&P 500 is all owned through passive investments, over 60%. So that means those passive investors, if they sell, if you will, there's no buyers because, in other words, you got two-thirds of the market. When they sell, they all sell. There's no buyers. So the other half, so who are they going to sell it to? Who? In other words, you could see some massive, if 60% of the market wants to sell, because again, it's passive, and that's the way that the passives work. So if you have the QQQs, for instance, if you own the QQQs and they go down, it's such a massive amount of money that when they go to try to find a market maker, it's like good luck finding one. I mean, see what I mean? It creates instability in the market when you have that much passive money in it because there's no active traders in there wanting to buy. The market makers are going to get they're going to get swamped because these. For instance, I give you one example is that some of these funds are so massive, right? That you have like $1 trillion in one fund, $1 trillion, right, in one fund, and they want to sell 5%, right? They want to sell 5% in one day. Who's the market? Who's going to want to pick that up, right? It's like the market makers are going to get absolutely overwhelmed. And that's one fund. Now you add like 3-4 of these massive funds that are all trying to sell 5% in a single day. Good luck finding a market maker. And so what that does is it creates extreme volatility. The market maker will go, okay, I'll buy, but you're going to have to give me, I'll buy it at, a lot lower level. So that I think that passive income creates a lot of volatility in this market today. And then the other thing is, which is just as important as the passive income. Passive income is probably the biggest reason for the volatility because you have these massive funds. Whenever they try to sell, it's going to be difficult for the market makers. But the other one is there's $64 trillion in the U.S. stock markets. 64 trillion. 20% is foreign money. Historically, that's at an all-time high. Historically, it's like less than 10. If you go back to pre-2010, but the reason why it grew from 10 to 20 is because the U.S. has really been the only game in town. Nobody, Europe's been dead, right? They haven't had any growth at all, and then Asia has been kind of dead. Japan, so the U.S. has been the place to make money. So all this foreign money has flowed in here over the last 10 plus years. We're up to 20% of our stock market. Well, that money's hot money. So 10% of 60 trillion is 6 trillion. If you double that, it's 12. So $12 trillion in our stock market is hot money. In other words, it's only here to make money. In other words, they're not going to be as patient as a U.S. like a pension fund. For instance, a pension fund isn't really hot money. They stay invested, right? 401k plans, by and large, they stay invested. But foreign money is like, it's a trade for us. We're in the U.S. market as long as we're making money. Once we're not making money, we're leaving. So that's a chunk of money that's leaving quickly. So you got that. So we're talking big chunks of money, right? The other one, the third one, is your baby boomers. The boomers have all the money. I mean, if you look at how many trillions of dollars the boomers have, it's kind of insane. The boomers have all the money. Right now, this is unbelievable. The boomers have more money in the stock market today than they've ever had.
Why, Don?
Well, the reason why is because they had a bunch of they had, the stock market has basically risen 50% since 24. So they just keep accumulating money, accumulating money. So they started with a lot, it's gotten bigger, 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 bigger. So what's happened is that the boomers were going into retirement, 2010, say, when the early boomers, right? Well, in 2010, from today, the stock market started growing, right? The stock market was dead from 2000 to 2010. It was pretty much dead. And then the stock market started growing in 2010. Well, the boomers hadn't retired yet. So the boomers they had all their money in the stock market. They haven't had a reason to get out. So they've stayed in. And so the boomers are way overweight the stock market. They're all in retirement. Not all of them, but 80% of them are in retirement. They're all in retirement years, if you will, right? I'm at the bottom end of the boomers, and I'm in retirement age, right? They're all in retirement age, and most of them are fully invested in the stock market. Guess what? That's hot money. If you're in retirement, right, and you got 70% of your money in the stock market because you've been making money, and you don't want to pull out, you're going to pull out quickly, right? You're not waiting for 5,000 on the S&P. So between now and 5,000 on the S&P, I see a lot of money going to the sidelines. Now, the last time we had this crash in April of this year, I don't think you had the fear level that you have today. That one bounced really quickly, but the AI trade, Nvidia was still strong then. That AI trade was still pretty solid. Plus, the tariffs, the reason why it all crashed was because of the tariffs. In other words, I think that crash happened too early. It was too early to get everybody out on the sidelines. But I think this next one is not going to be too early. I think this next one, I think people are going to jump out. And here's the key to it all, I believe. It's two things. One is going to be Nvidia going down because everybody's going to go, whoa, the AI trade, that's holding everything up. And then number two, I think the other thing that's going to really pull it down is employment. If you go back and look at employment back in April, it was still pretty darn solid. In fact, employment didn't start to drop until May. May and June is when the first time that the employment rate started to break. So in April, everybody's everything's fine, and so they stayed in. I don't think they're going to stay in next time.
Do you think, couple questions, do you think, who let me back up a second, who will be impacted the most by this crash? And before you answer, let me share with you what I think and tell me what your thoughts are. I think the boomers, because they have all the money.
Actually, no. Well, the boomers' standard of living is going to be impacted in a way they're not going to be happy with. I'm not happy with it. Remember, I said earlier, I talked about the U.S. is not going to be able to stay together over the next 10 years. We won't have 50 stars on our. I don't even think the United States will exist in 10 years.
I want to ask you what you think that looks like too, but sorry, I didn't mean to interrupt you.
Right. So basically, we're going to have a lot of supply chain problems, and so if you're a boomer, you're in retirement, and you've had this beautiful life. I mean, we really have. We're all in America. The only thing that's happened in America is our standard of living has went up. Now we have had a lot of political dissension where we're not real happy with it, with the trend of the politics in America. That's for sure. But as far as materialism goes, most of your boomers have done really, really well. Now, they will be impacted by this. And again, standard of living will be impacted to a certain extent. But the painful part will be their kids. Their kids will feel it more. The millennial generation, the Generation X, Generation Z.
My generation.
The people that are younger, they're going to feel it a lot more severely, if you will, than the boomers will feel it. And the boomers will have, a lot of the boomers will be able to move to a place where, they're more safe. They'll be able to leave, like they live in an urban area. I'm out of here. This isn't, this isn't the safe zone anymore that used to be here. I'm out of here. They'll be able to afford to leave. And so they're in a better position. There's going to basically be winners and losers, but the overall, it's going to be we're already seeing it. It's going to get worse and worse. We're seeing, people aren't getting married until they're 30. They're not buying their first house until they're 40. It's getting uglier and uglier. At least 25% of college graduates can't find a job, and another 25 can't find the job they want. So it's getting harder and harder to find jobs like college graduates, and then they have more debt. So things are spiraling downward. And so, so I think the brunt of this is absolutely going to be, the sub 40 group, sub 40s.
Yeah, I'm 47, so I'm in that Generation X. But I ask you about the boomers because the hit that they're going to take, they're older. It's going to be harder for them to make that money back up versus my generation and young people. I have friends that have kids that are 18, 19, 20, and they're worried about their future. And I get it to a certain extent, but I also say to myself, I don't have kids, so it's easier for me. I can always be a critic when you don't have them, but they're young. They have time. They've got a whole trajectory ahead of them. No,
nope. Sorry.
Or correct me, Don.
No, we're not. So I'm a bit of a futurist. I've been studying the future since 1989. Materialism. So we look at how we live today, which is a very technological, materialistic society.
Shallow. Can I share, let me just share with you. I put it on X last night. A friend of mine said, "We live in a griftocracy," which I thought was an appropriate term.
Well, right. Well, it's starting to become somewhat exposed that society is becoming somewhat untenable, if you will. It's breaking down. But my point about the younger generation having time, unfortunately, no. The reason why they don't is because we are the generation that basically witnesses basically the collapse of if you will, of I'm just going to focus on America, but it will affect the entire world, of America. And so they will have to rebuild it. Not only will they have to rebuild it, but they will have to create something different. In other words, it's going to be a completely new civilization, if you will. It will be no fun. It'll be very hard. So they won't have time because they won't have time because they are not. This isn't going to be a normal business cycle where we just kind of go down 1, 2, 3 years and then get back on our feet and materialism carries on. That's not what's going to happen. Materialism is going bye-bye. And so the question is, what's going to replace materialism? And that's, to me, is very unsettling. Now, when we come out the other side of it, it's going to look completely different. And so it's not really about. So they have no time at all. There's no time. It's for them. It's just challenge. They're going into a challenge where they have to rebuild the whole thing. You see what I mean? So it's going to be no fun. The easiest is people it's going to be on people that are under 21. The really young people, the teenagers, that they're going to be the easiest because they didn't lose anything. They don't know what they lost, right? So they'll have it the easiest because they'll just be about, okay, how do we rebuild this thing, And then the 20s to 30s will be the next group that have it the easiest. Anybody that's the hardest is going to be over 50. The older you get, the harder it will be because change is hard. And the problem is we're used to living a certain way. And then when you get rug pulled, it's like, oh God, because you have these expectations. That's the hard part, right? You have these expectations of how things are supposed to be. And it's not going to happen. Everything's going to, we're the rug pull generation, but we're also the generation, we're the rebuild generation. We get to create something new. But we're not, this is what people don't understand, is that what we're going to create doesn't look anything like today. It's going to be a completely new civilization, which nobody's ready for. So I've been on the sidelines waiting. That's why I got into gold and silver. I got into gold and silver in 2004. I actually became a gold bug in 1989. I got into gold and silver because I know it's going to work, because I know what's coming. I know the bond market's going to fail. I know gold's going to the moon. So I started collecting gold and silver miner stocks, waiting for that outcome. And then I've been very patient, but it's been easy for me to be patient because the world hasn't woken up yet to the future. So I've known the future since 1989. So I'm just sitting back waiting for people to wake up. And I drop these little truth bombs on my X account, not only about once a month or so, waiting for people to awaken. And nobody, the truth hasn't been exposed yet. I keep waiting. I watch these Netflix series, and I keep waiting for the truth to come out. It's coming. It's coming. I know it's coming. The irony is that gold and silver are going to break out about the same time that the truth comes out. And so I'm going to pivot from gold and silver. I'll sell all my gold and silver mining stocks. I'm going to pivot, and then I'll pivot into the future where we're going, and then help people move forward, because I have an idea. I actually wrote a book, if you're interested. It's called The Path Forward, that explains where we're going, the change, and basically the irony. This is kind of mind-blowing. It absolutely is mind-blowing that the breakdown of society that's about to happen coincides with the awakening of humanity, it's absolutely mind-blowing. So, normally we're not supposed to know the truth, because if you know the truth, we couldn't live in, the world wouldn't be like this. You would not have diversity if once you know the truth, diversity starts breaking down. In other words, good and evil, good and bad. Once you know the truth, that all starts going away. And so this planet, if you will, our civilization, we forget. And the reason we forget the truth, the reason why we forget is so we can experience diversity. It's kind of a school, if you will. But we're the generation that decides to wake up, which is amazing to me. So I keep waiting. And so, and it was interesting. Somebody actually posted something on X. I keep my eyes open and wait. Somebody says something, and somebody posted about a week ago. So I'm waiting for it to slowly come out. Somebody posted recently. It was a scientist, and the scientist said that something to the effect that consciousness is the building block of everything. And I'm going, somebody figured it out. All right, we're starting to go down that club. So basically, let's put it this way, is that what I'm about to tell you is absolutely true. And the truth is always true. That's the definition of the truth. The truth is always true. It was true yesterday, it's true tomorrow. Everything else is an idea. It's either an idea or it's the truth. Now, what I'm about to tell you is the truth. It's possible for us to turn off the volume, both of us turn off our volume, and communicate to each other using telepathy, and just continue this conversation. That is real. That is possible. Now you got to go. Now we can't do it. The only way it's possible, but the only way that you could do it is to raise your vibration high enough. So we're basically vibrating energy. That's what we are. But if we raised our vibration, so in other words, we are connected. Me and you, everything is connected. But we are connected consciously, because everything's conscious, everything. So the air from here to you, the whole thing, it's like the Matrix, in that movie, The Matrix, everything was interconnected. It was like a computer game. But in the computer game, it was all ones and zeros, and everything was connected, right? That's how it really is. We are connected, me and you, consciously, because consciousness is, again, the building block of everything. So once people start to awaken to the fact that there's no separation is an illusion. There's no separation doesn't exist. It doesn't exist. And so this is the truth. I'm waiting for people to awaken. It's going to happen. And once you become aware of your source, so if we're connected to each other, where's our source, right? What connects it all together? Where's the source of our consciousness? And so once you figure that out, war ends because you can't kill yourself. There's no more wars. And I've been telling people, it's going to be amazing how fast what I'm explaining to you. It's going to be amazing at how fast this happens. And the reason why it's going to happen quickly is because of the internet. It's like once people start sharing this, it'll speed up really, really quickly. So by 2035, 10 years from now, there will be no more wars between countries in 10 years. That's mind-blowing in itself. It's like, what? How in the hell can that happen? Right? We got these massive wars happening. You're telling me there's going to be no wars between countries in 10 years? Are you out of your mind? That's what's going to happen. Now, there will be internal wars, internal civil wars, but governments will not create armies because it doesn't make any sense to create an army. But the people inside your borders, they will be in denial of the truth. And they're like, it's total BS. We're not connected to each other. And they'll be able to, so there will be internal wars for a few more generations. Internal stuff will occur. Basically, guns aren't going to go away. Nuclear weapons will go away. Missiles will probably go away. But guns won't go away for a while, not in our lifetime.
And you'll have more technology. You'll be a part in the war as well, right? Domestically within the United States, where like the Palantirs and debanking.
It's really interesting. So I've been doing this since 1989. It's really interesting that we're reaching a point where AI, not just AI, but technological innovation is getting so advanced that we better wake up real quick or we're going to blow ourselves up. For instance, these hypersonic missiles cannot be shot down, right? So you can put a nuclear warhead on a hypersonic missile and, for instance, North Korea, how many years away, or Iran, how many years away are they from, putting a nuclear warhead on a hypersonic missile, put it in a submarine and blowing people up? So you got that going on. So we have this technology is rapidly increasing. At the same time, the world is becoming a more dangerous place. So it's like the universe basically says, okay, before you guys blow yourself up, game's over. So they're basically ringing the bell. Game's over, guys. Wake up. We're going to do it's over. That's kind of what's happening. And then AI, right? AI is on the scene, and AI is destroying the economy. Right? It's destroying the economy, AI is. The reason why it's destroying the economy is because it's destroying jobs. AI is a job killer, absolute job killer, right? Automatic driving, that's a job killer. So it's like technology is kind of invading society. The other thing that's also happening is the cultural divide is getting so perverse, if you will. What I mean by perverse is you're having like Muslims come into like England, in Canada, right, and kind of take over the country. It's like, what the heck's going on here? So it's like humanity has reached a point of no return where you can't, okay, you guys have had fun. You've experienced this massive diversity, but it's game over. It's like, no, that's as far. It's like the universe says that's as far as you can go. And now we're going to ring the bell. And so the bell is going to get rung here this decade. And I think it's going to be 27. I'm calling 26 the last year of Easy Street. It's the last, and it's also the last year of kind of living kind of blind, I don't know if that's the right word.
Blissfully unaware.
Yeah, blissfully unaware. I think 26 is the last year of that. And then when we hit 27, it's like, the wheels came off. It's like, uh-oh. And I think that COVID was really the warm up. It was the warm up for massive change. And now the massive change is 27, I believe, from 27 forward is coming. And nobody's ready for it. Nobody's ready for it. I mean, maybe 1% of humanity is ready for it. But the younger generation, 1% of the over 50 crowd, the younger generation, the under 18 crowd, they're ready for it. They are, because when you're young, you're very idealistic, and you have this mentality of whatever it takes. That gives me hope. It's that younger energy that basically, how do we fix this kind of thing? And I know where we go as a humanity, we do succeed in a big way. It's going to be, by the time we get to 2050, for instance, um, it'll be a much better civilization across the entire planet by 2050.
I know I'm running out of time here with you, but I do want to get your take on where does crypto then go from here to the future?
So what people have wrong on crypto, a lot of people call crypto a scam. And these are just all scams. They're all Ponzi's. They're all worthless. But what they're doing is they're throwing the baby out with the bathwater. And they're kind of looking at Bitcoin, and then they put all the other cryptos in the same bucket as Bitcoin, and they think of Bitcoin as like this fake money that has nothing that's backing it. But what they miss is that what Bitcoin invented was the blockchain, and the blockchain has tons of potential, tons of uses, and so the blockchain's not going away. And so crypto's not going away. But the beautiful thing about, and this is where the skeptics kind of have wrong, if you will, the beautiful thing about crypto technology is the ability to basically have your own money when you're on your phone. In other words, the third party doesn't hold it; you hold it. That's a big change. It is a very beneficial. And so, for instance, you have money on your phone in your wallet, and it's you own that. The money's literally in your wallet, right? It's a crypto. And this doesn't have to be Bitcoin. It could be a stable coin. It could be any crypto, right? But it's in your personal wallet. So you go to buy a car or a truck, and you go in there, you can literally transfer your money. You don't have to use a credit card. You don't have to do a wire transfer. You don't have to call a bank. You can literally transfer money out of your wallet into their wallet and walk out of there with a car. That is very powerful advancement, right? With money creation, money usage. That's the future. That's not just the United States, that's the entire world. The fact that we can basically remove banks from that whole thing is a leap forward, I believe. And so blockchain technology, I've always been a fan of it. I've always thought that blockchain technology, because it keeps evolving. To this day, they're competing against each other. I mean, Ethereum has a lot of competitors. They're nipping at Ethereum's heels, trying to catch up to Ethereum with what Ethereum does, all of the use cases. Tons of competition, which I think is a good thing. So I'm a fan of the blockchain. Now, Bitcoin, that's really difficult to know the future of Bitcoin. Nobody knows the future of Bitcoin. We're all guessing, absolutely guessing, because we don't know what the utility is for Bitcoin. I get the fact that Bitcoin has a bit scarcity, 21 million Bitcoins. I get the scarcity thing, but you can't really nobody. I mean, Michael Saylor seems to think it's the best asset. It's going to trillion plus. I think he says 21 trillion per Bitcoin. He doesn't know that. He's just guessing. We're all guessing. Bitcoin's going to have to prove its utility, but that's Bitcoin. All the other projects are blockchain technology. They're not just blockchain. Some of them are competitors to blockchain. They're just new types of decentralized database that people. So blockchain basically spurred new technological innovation. I mean, like for instance, if you look at HBAR is not a blockchain. But it's a decentralized database. It's very similar to blockchain. So we're seeing, these new iterations, if you will. So yeah, I'm bullish. I'm bullish blockchain. Let's put it that way. I don't know what's going to happen to Bitcoin. I'm hoping it succeeds because there's a lot of people that are invested in it. A lot of people will make money. I don't want to see it fail. That'd be a lot of people will get hurt. I want it to work, but I can't tell you with certainty it's going to a trillion. I do think it's going higher, but I'm guessing, just like the same people are guessing it's going to zero.
Last question. As we've talked here now for a little over an hour, does it make you think, being in Arizona with lack of water, do you consider any of that? Like, all right, maybe, because I ask myself that question all the time, and I'm going to get heat if I end up staying here a little bit longer, because most of the year I was like, I'm leaving. There's no water here. This is not meant for 8 million or whatever it is, 7 million people to live. And what you've just talked about, the change, because I think in the next year or two, this country is going to look drastically different than it looks today. It already looks drastically different from 2020 as we're coming up on 6 years since the pandemic. I mean, and life is never going back to what it was before. So with that being said, does that make you think, all right, maybe the Southwest is not a great place to be?
If I answer this question, I'm going to be looked at as a complete nutcase. I can't. I think it's too early for me to answer this question. The one way that I will answer it, down the road, if you will, I'll answer this question about the best place to live, the best places to live, if you will, and the reasons why these are the best places. But right now it's a little too early for me to answer this question honestly, if you will. But I will say this: we live in the Phoenix area, which is an urban area. I believe that there will come a time, I don't know how many years we have left, 1, 2, 3 years, there'll become a time where you won't want to live in the urban areas. It's that simple. And the reason why you want to live in the urban areas is just because they're just, put it this way, too much lack of harmony. Choosing my words.
Lack of community. It's a big urban area, so you've got people from all over the place, and especially in Phoenix, and we can both speak educated on it because we're here. You've got a lot of people that are not from here, which is really true of any urban area in the United States today, that are not vested in the community, and things start to break down as they have been, you're going to have a lot of angry people, and angry leads to worse and worse and worse. And we both know where that's going.
Right. So yeah, you can kind of connect the dots. If things go south, the urban areas aren't going to be the best place to live. So, I told somebody a couple of weeks ago, I said, I'll stay here as long as I feel comfortable. But, once I feel uncomfortable, I'll probably leave. That's kind of the way I look at it. But I do think that the urban areas, a lot of people will leave them in the next few years. But the rest of the Arizona area, as far as water goes, I don't see that as being a problem anytime in the near future. The next 10 years, for instance, I don't see water being a problem. I could be wrong. I don't think that's the threat to Arizona. Let me put it that way. But I'll talk more about locations in the future. But I think it's too early to talk about now.
Don, where can people find you?
So if you own a gold and silver mining stock, then you want to basically check out my website. If you don't own a gold and silver mining stock, but you think maybe you might want to, then read my book. It's on Amazon. Just go to Amazon, Don Durrett, and look for, it has the black covers, look for my gold book. And that's kind of, you can also follow me on X at Don Durrett. Thanks.
And then your website, for the audios, for people that are listening and not watching, what's the website?
Goldstockdata.com.
Do you have a Substack too? Did I hear that?
I do, at Don Durrett, Substack.
Don, I appreciate you doing this. I enjoyed this conversation. Love to have you back on because God knows there's going to be a lot to talk about in the short term and in the long term. So Merry Christmas, Happy New Year, and look forward to continuing to follow your work.
All right, we'll do it again.
Mic drop.